Hello everyone, welcome back to my channel. In this video I'm going to go over 3 commonly used day trading strategies. The 3 strategies we'll take a look at are the break of highs momentum strategy, the exponential moving average or EMA pullback, and the support and resistance levels. Now let's keep in mind that there's no strategy that works 100% of the time. So the break of highs or momentum strategy views a break of highs paired with increased volume as a bullish indicator. Often a limit order is placed above the current highs. This can be a break of day highs, weekly, yearly, or all-time highs, but often momentum traders are focused on a break of day highs. This will need volume to support its move. When we look at this 5-minute chart on ticker INDO, we can see we had volume to support the move. We made 7 5-minute highs and went from a low of 261 to a high of 921. This is a great example of buy high, sell higher in a momentum style trading. The next strategy we'll look at is the exponential moving average or smooth moving average pullback. This strategy will look for pullbacks to the EMA or SMA indicators after a strong move in a price action. Often traders use the 1 or 5-minute chart when looking at EMA or SMA indicators. The 9 EMA, the 20 EMA, and the 50 EMA are commonly used indicators for day traders. Often traders will enter at the 9 EMA while using the 20 EMA as their stop loss level. This again will need volume to support its move. When we look at that same stock, ticker INDO, but this time on a 1-minute time frame, we can see the purple line represents our entry, the 9 EMA. The 20 EMA is our stop loss level, which is the yellow line. We can see the purple line provided multiple entries for a great trade before crossing the yellow line. This is a great example of the 9 EMA pullback on a 1-minute chart using the 20 EMA as a stop loss level. Last, we'll look at the support and resistance levels. In this strategy, we look to wider time frames to identify areas of possible support and resistance. Most traders use daily or weekly charts when identifying levels of support and resistance. When using candlestick charts, traders can benefit from marking both the body and the wick of previous candles. Day traders often mark support and resistance levels on a daily or weekly chart, then switch to smaller time frames to identify possible entries and exits. And again, this will need volume to support its move. For this example, we'll pull up the day chart on ticker SBEV and we'll mark the obvious levels of support and resistance on the candles and wicks that we see. After we mark obvious levels of support and resistance, we'll switch to a smaller time frame such as the 10-minute chart. When looking at this smaller time frame, we get a clearer picture of possible entries and exits, providing we had volume to support the move. Now again, keep in mind, there's no one strategy that has 100% success rate. Momentum trading is an example of buy high, sell higher. The EMA or SMA pullbacks can help identify support and resistance levels fast for a possible entry or exit. Some trading plans use the 9 EMA as an entry and the 20 EMA as a stop loss level. The daily and weekly support and resistance levels can help identify possible points for entries and exits. Volume is key, and always have a plan when trading. That's all for today's video, guys. Make sure to like and subscribe, and I'll see you in the next video.